makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. President Donald Trump has insisted he does not plan to fire Jerome Powell. In an interview with NBC's Meet the Press over the weekend, Donald Trump saying again he will not remove the Fed chair, and that's despite some repeated criticism over the pace of rate cuts.
He should lower them, and at some point he will. He'd rather not, because he's not a fan of mine. Just doesn't like me because I think he's a total stiff. And, it's just one of those things. He should lower them. And I wish the people that are on that board would get him to lower, because we are at a perfect time. It's already late, but he should lower interest rates.
Let's bring in Bloomberg's Valerie Teitel. Val, walk us through what we should be taking away from those comments.
Look, I think one big takeaway is the market is starting to agree more with Powell than it is with President Trump. We are continuing to price out those rate cuts from the Federal Reserve for this year. Take a look at how two-year yields have traded in the last two sessions. On Thursday and Friday combined, rising over 20 basis points. We've now priced out the first Fed rate cut to come past July now. And the expectations, Kriti, for the Fed this month is that they're going to hold rates steady at their meeting on Wednesday. The Fed funds rate is expected to hold at 4.5%, but we are getting calls across the street pushing out these rate cut expectations, the like of Barclays and Goldman, both after that hot payroll print on Friday, pushing out their Fed cut call to July instead of June. Now, this is chiming with a lot of market optimism. The S&P 500 has rebounded now, completely erasing those losses since the April 2nd tariff announcement, and we are on a winning streak in the U.S. equity market. It's been 9 days of gains for the S&P 500. We are pointing lower in the futures market, however.
Talk to us a little bit about how some of the other central banks, perhaps, and the other currency markets are pricing in what we might expect from this week ahead.
Yeah, it's a big week for G10 central banks. We have the Fed kicking things off on Wednesday. But then on Thursday, we have the Riksbank and the Norges banks here in Europe. They're expected to stay on hold. Some real fireworks could come later on Thursday. The Bank of England's decision comes around noon. They are widely expected to cut, but there is some speculation that they could be very dovish about the path ahead, perhaps chiming with the dovish tilt that ECB Lagarde gave us a few weeks ago. Now, the front end of the UK, those two-year yields have really outperformed since the Trump's tariff announcement, down around 40 basis points. So we are pricing in a more dovish path ahead for the Bank of England.
Bloomberg's Valerie Teitel walking us through some of those market moves. We thank you so much. Let's talk a little bit about how you play that, how you allocate in this very volatile environment. I'm pleased to say from Paris, I'm joined by Alain Bokobza, head of global asset allocation over at SocGen. A pleasure to have you on the program this morning. Thank you so much for making the time for us. Alain, to me, if I was allocating right now, bonjour, from London, if I can say that. If I was allocating right now, my portfolio would probably be something like an AI grid, a little bit of Apple, perhaps a carton of eggs in there, and a little bit of private equity, which is why I don't have your job of global asset allocation. Walk us through what the right division of assets are right now in a portfolio.
So we have entered with all those policy uncertainties a period of higher volatility across the board. It's the uncertainties generated by the which end policy are we going to live over the next quarters, which generates this. And markets are leaving the announcement one after the other. Sometimes it's bad news, as we've been living from January to March, and then the relief when we're entering more a transactional way to do the trade policy. But this is going to continue over the next quarters. So overall, we do not advocate for high risk quantity, especially at this level of the S&P. We are reasonably cautious on the overall risk taking. Also, the puts we have, so what kind of good news we could have. So we have seen the couple between Scott Bessent and President Trump going from too much ideology into brackets into more transactional and way to negotiate to have something smoother than expected before. I do not think that we have yet the Federal Reserve put Everybody is delaying the start of rate cuts, and there is a very big question mark. I think that is going to be the next chapter for asset allocation. What is going to be the reaction of producers, exporters, and distributors in the US towards inflation? And the risk, as we have seen lately, is that the underlying economy remains relatively robust in the US. You have seen the job numbers on Friday, which were robust. They were not good, but robust. So the underlying economy remains relatively robust, but there is a threat that inflation numbers by summer are going to rise quite significantly, and that is definitely a no-go for the President of the Federal Reserve to cut interest rate too early. It will come in the second half of this year, but 3 months might look like infinite time in those market environments.
Oh, absolutely. Well, let's go piece by piece of the argument you just made. Let's kick it off by starting with just the trade policies specifically, and then we'll get to the Federal Reserve in a moment. When it comes to the trade story, so much of the narrative has been that the uncertainty and the unreliability emanating out of Washington, D.C. has created this exodus of fund flows from the United States. How much of that is sustainable, though, in terms of reducing exposure to the U.S.? Can an international investor afford to not be allocated to the U.S.?
We have launched in March the idea of the Great Rotation. The Great Rotation starts from the excess portfolio concentration on U.S. assets. It was an excess concentration on the U.S. dollar, on U.S. equities, which are above 70% of global equities, on U.S. credit, private equity too. So what we read on the allocation of global capital, whether it is based in the U.S., whether it is based in Europe or Asia, the concentration of portfolio is too narrow. So we have been arguing for a while for portfolio broadening, and the alert we have had in the last quarter on U.S. assets underperforming in a wide range. So U.S. treasuries have underperformed, U.S. equities have underperformed, U.S. credit has underperformed, is the alert that portfolios must broaden. And we need to find not only relative, but positive thinking, a bit like Warren Buffett will have done in all his career, that you do not own an asset for anti-negative reason. I don't like the US asset, and so I have this one. You need to have positive thinking when you work on Japan, when you work on China, when you work on Europe. It needs to be positive thinking in order to reallocate. So it's not a passive way to invest. It's extremely active, and we are digging into what we nickname the game changers, which can make a value territory like the yen, like Chinese equities, like European equities, if not the euro itself, in order, what are the game changers potentially for reallocation of flows to continue?
Well, in the absence of that reallocation or in that wait-and-see mode that you're outlining there, walk us through this moment in the sun that Europe is having. The last quarter, Europe had, I think, one of the best quarter in decades because of that fund flow, one that preceded that of Liberation Day as well. Well, you didn't just see it in the equity market. You saw it in the bond market. You saw it in the euro as well. Alain, there's a lot of people who are looking at euro dollar at 113 and saying, how is that possible in the face of such structural weakness in Europe?
So, if I had, we in the forecasting group of people, we love to work with letters, the L, the U, the V, the inverted U. And in this one, for Europe, we have the idea of a J curve. So in the very short term, Europe is burdened by the weight of uncertainties, even more than the trade barriers. We think overall that Europe will end up after negotiation with a 10% tariff barrier. That is very, very capable, that region, to absorb that, let's say, 0.3%, 0.4% of GDP downgrade for this year. It is not a massive hit. The uncertainty is more the J here. And then you have all the reflation plans from REARM, so the defense, where Europe will take over what the US were doing for them. And you have infrastructure plan led by Germany, but Northern Europe is going to be significantly more investing in the future, in digital, it is in infrastructure, it is in energy policy. So that is something new. And the currency market, as you did mention, sometimes are very short-term minded, sometimes are also on looking through on the scenarios, and that J curve is the profile of European assets at which you keep in mind.
Talk to us a little bit about the commodity space then, when it comes to not just gold, which seems to be the hedge for everyone, but also the story of oil here. We're seeing real oil taking a massive beating this morning. We're looking at a 59 handle on Brent crude. Do you expose yourself to that kind of asset when the story of economic resilience out of the United States off of payrolls, which you had mentioned earlier, still rings true?
So on the commodity space, we had for many quarters zero exposure. Let's be very clear that the asymmetry of the profile for commodity demand was negative. So there was a glut of offer and some risk on the growth profile around the uncertainties created by the new US administration. And we have on top of this for the oil, in which again we had zero weighting, is the 4 million barrels a day excess production capacity you have in OPEC Plus at a time when in the last few years since the pandemic, the US had increased the fossil fuel production by a similar amount. So we had in the background something which is materializing today, which is somewhat of an exchange of market share. So OPEC wants to regain the lost market share very explicitly. On the very last messages we have received, they are very explicit. They are going to continue to pour more barrels on the market. So for now, there is still this asymmetry on the energy markets. I would stay put for now. And that will feed through some positive news flow on inflation a bit later. But for now, on the commodities, we stay put. We much prefer copper and electrification long-term idea than the energy market for now. And we still have on the commodities exposure 7% on gold. I remind you that the overall exposure is between 2.5% and 3% on global portfolios. So we had for since 22, by the way, a significant exposure to gold, which may need to breathe on the road to more pragmatism from the US administration. We may need to leave somewhat of a pause on gold for now.
We've covered, I think, every asset under the sun in this short conversation, Alain. But I'm curious if the Federal Reserve is paying attention to any of it. And you, at the very start of the segment, made the point that a cut from the Federal Reserve is likely to come in the back half of this year. In your view, what do you think they're going to be responding to primarily?
So we are all gradually downgrading the US growth profile. So we are moving away from US exceptionalism we had for several years, and that is triggering the great rotation we have been discussing earlier. And that does not deserve a monetary policy which is tight. So we are removing the threat of the Fed going tighter than what they are today. So there is an asymmetry, which is to cut or not to cut. And you have the growth profile, which is at risk. But for now, we are still above zero. All the ones who had a very severe and quick to enter recession scenario in the US have been forced to normalize to some form of slowdown with no major recession. But the biggest threats to the Federal Reserve, as they have a dual mission to boost the growth but also to control inflation, that one is under threat. We don't know yet the impact of these new uncertainties and tight policies and protectionism on the inflation. Without any doubt, the inflation numbers are going to worsen. To which extent, we are going to discover by summer. This is why the Federal Reserve can't cut by then. And the very last point will be the risk on the systemic risk that if you do maintain interest rate too high for too long, the mortgage rates are still between 6 and 7. They're extremely high in the US. So that burdens the property market, and you have systemic risk behind. So on that one, the Fed will have to act sooner rather than later, but they are stuck because of inflation. So you see, the dilemmas the Federal Reserve and Powell himself have. For now, he cannot cut interest rate. The cuts will be for the second half. Whether that can avoid and trigger something else than a recession is a big question mark.
Alain, Bokobza, too short of time. I could go on for hours with you. Head of Global Asset Allocation at Société. We'll leave the conversation there. We thank you so much for coming on the program. Coming up, we're going to dive into the story with Berkshire Hathaway. Warren Buffett to retire from the company after 60 years at the helm of one of the world's largest companies. Berkshire shares down about 2.7% in the pre-market as they talk about a $350 billion cash pile. That conversation next. This is Bloomberg. Warren Buffett has announced that he intends to step down as CEO of Berkshire Hathaway at the end of the year, handing the reins to energy executive Greg Abel. Charlie Wells here with an update. Charlie, walk us through the legacy Warren Buffett is leaving behind at Berkshire.
Crude, it is a legacy that is hard to believe, even when you quantify it. You see that return of 5.5 million percent from 1964 to 2024. Such an incredible return over time that translates to a 20% annualized return. One of the reasons why investors have so loved this Berkshire stock. But it's not just that. It is also the cultural legacy that Buffett will leave behind. People flocking to Omaha over time just to get a glimpse at that oracle.
I mean, the way he sells out stadiums is wild, giving Taylor Swift a run for her money. Walk us through the successor, I'm going to say this right, the succession plan. What does Greg Abel bring to the table as CEO, Charlie?
Yeah, so Buffett will step down at the end of the year and Abel will then take over as CEO. He is very much seen as continuity here. He joined the company in the year 2000. He really rose up the ranks on the energy side of this business and has a reputation for being able to get into the weeds with these companies and run them well. That said, there are still questions as he follows in the footsteps of Buffett, in particular his ability to pick stocks. This is not something that he's known for, but we know that stock picking is something that made Warren Buffett famous.
Walk us through the challenges, though, here. What is this transition? What is Abel going to have to deal with as he takes the reins?
Pretty. In a lot of ways, it looks like Berkshire Hathaway is sitting pretty. They are sitting on a $350 billion cash stockpile. Now, just to put that number into context, that is bigger than all of the Ivy League endowments combined. That sounds great, but this company is under pressure from investors to start to deploy that capital. And there are going to be questions on how Abel does that, if he is able to do it in the same way as Buffett, or if he takes a different strategy.
You know, fascinating here, of course, as the Oracle of Omaha has been such a big player when it comes to value investment and, of course, consolidation in the energy industry. Maybe that's where Greg Abel takes us next. Bloomberg's Charlie Wells walking us through the numbers and a truly once-in-a-lifetime legacy of Warren Buffett. We thank you so much. Let's go from the corporates in the States to the corporates right here in Europe, because earnings season continues this week with the focus on car makers and auto parts producers, a sector weighing the impact of President Donald Trump's tariffs. Let's bring in our very own Laura Alves out of Frankfurt for more. Laura, walk us through some of the major earnings themes this week.
So companies reporting earnings this week, they come from a number of different sectors. We, for example, have some banks reporting, such as Commerzbank and Générale. We have consumer companies reporting like AP InBev and Puma. And then, of course, as you said, and as we will delve into a bit more deeply, the car makers and the car parts makers. Many of the companies that are reporting are German, but we also notably have two of the most important Danish companies this week, namely Novo Nordisk and Maersk. And if we look at an overarching theme, we're pretty much looking at the same theme that we've looked at throughout the entire earnings season, which is tariffs. We're looking for guidance from companies as to how they would be impacted by tariffs directly. We would also like to know whether these companies see indirect impacts from tariffs, for example, through a potential recession, whether they want to increase their investments in the US, and so on and so forth.
Well, let's circle back to where we started, Laura, which is with the automakers. Talk about the response from them, given the current uncertainty. What can we expect from the likes of BMW and Continental this week?
So we've kind of seen two different strategies as to how automakers have responded to the tariffs with regard to their outlook. Companies like, for example, VW, they've stuck with their outlook and they've decided to kind of qualify this and say that this doesn't really impact or include any impact from any potential tariffs. And then other automakers, such as, for example, Mercedes last week, they've pulled their guidance and they've said that they're not really in a position to provide any sort of reliable outlook in the current situation. So it remains to be seen which of these strategies BMW is going to choose. And another automaker that's reporting this week is Ferrari. And the situation for them is a bit more hopeful because they have more pricing power given they operate in the luxury segment. But still, overall, we see that there are still many open questions when it comes to the impact that tariffs are going to have on automakers in this earnings season.
Well, so much of the story with the automakers, there's a direct line to the story of the defense makers as well in terms of CapEx spending, et cetera. Walk us through the story with Rheinmetall and Leonardo.
So yes, Rheinmetall and Leonardo are two of the defense companies that report this week, and they are both poised to be major beneficiaries of the current European defense spending boom. And when it comes to earnings specifically, what we're looking for from these companies is we're looking for some guidance as to when this increased defense spending is actually going to materialize in concrete orders for these companies throughout the year. And an important date that is going to shed more light on this is the NATO summit in June, where the alliance is expected to present some capabilities, to outline some expectations that they have towards individual member countries. And from this, it's going to become a lot more clearer to companies like Rheinmetall and Leonardo how the increased defense spending is going to manifest in their earnings going forward.
Yeah, truly a fascinating story when it comes to some of the earnings pictures this week and how they reflect the broader geopolitical story. Bloomberg's breaking news editor for Northern Europe, Laura Alves, joining us from Frankfurt this morning, setting us up nicely for the week. I'll mention one other sector we've got to keep our eye on. That is the banking sector. This morning, some news coming out of like Santander and Erste Bank. This comes after a kind of offshoot of Santander. Erste Bank is going to be buying Santander's Polish businesses in a €7 billion deal. Now, this is a big deal as given that Santander is actively pulling away from some of their European exposure, leaning into the U.S. and Latin America. Erste Group, of course, also getting a 49% stake in Santander Bank Polska for, as I said, about €7 billion. They'll also take full ownership of the Spanish lender's asset management unit for about €200 million. They're both shares higher this morning, but Erste Group really soaring to the tune of about 6.5% this morning. Let's get to one other story I have my eye on this morning, and that is coming out of India. Bloomberg has learned that representatives for the Indian billionaire Gautam Adani have been speaking to officials in the Trump administration about dismissing criminal bribery charges against him. Now, sources say talks began earlier this year, but intensified in recent weeks and could lead to a resolution in the coming month or so. Adani's camp said to be arguing that his prosecution does not align with Donald Trump's priorities. We're going to stick with the conversation of Donald Trump. You do not want to miss it. Stick with us. This is Bloomberg. Good morning and welcome to The Pulse. I'm Kriti Gupta in for Francine Lacqua in London. These are your top stories. The dollar weaker this morning as U.S. equity futures fall. Uncertainty surrounding Donald Trump's trade policies weighing on those American assets. And Warren Buffett announces he's stepping down from Berkshire Hathaway after 60 years, leaving his successor with a $350 billion cash pile. Plus, oil slumping below $60 a barrel after yet another aggressive supply hike by OPEC. Plus, we're going to dive into the details. But first, let's talk about the central banking story. It's a big week for central banks around the world. Decisions from both the Federal Reserve and the Bank of England in the coming days, among several others. Let's get a preview now with Bloomberg's Zoe Schneeweiss joining us from Frankfurt, not outside. Zoe, pleasure to have you on the program. Thank you so much. Let's start stateside here and talk about the Trump effect on Powell. He's repeatedly told Powell to cut rates. Why will that not happen this week?
Yeah, you're right. It won't happen this week. Powell and the Fed have repeatedly highlighted that they need to see more data. There are those Trump tariffs coming in, and that just creates so much uncertainty. At the same time, the economy is holding up quite well. We've got strong employment numbers still. We had a strong employment print on Friday, and inflation still is while it's slowing, that Trump tariff impact has yet to hit. So that just is no motivation for the Fed to cut at the time being. An economist survey we conducted last week said that the Fed will start cutting in September. So that's still quite a while off.
Walk us through the story for basically everybody else. We've got the Bank of England this week as well. Can the Bank of England afford to hold if the Fed holds? How does the Bank of England approach and think about what's happening out of Washington, D.C.?
Of course, there's always that gravitational pull of the Fed, that whatever the Fed does impact other central banks. This cycle is slightly different. The BOE obviously does not have that tariff impact that the Fed has. So the Bank of England is widely expected to cut by 25 basis points this week. Beyond the Bank of England, we have a flurry of other central bank rate decisions across the world. We have Norway and Sweden, who are both expected to hold, although for different reasons. At the same time, we have Brazil, which actually is in the middle of a hiking cycle. So really a very mixed picture across the world.
Yeah, a really fascinating one, as those are, of course, very exposed, I would say, to the European story. You already heard some of those Scandinavian banks really warn about that tariff uncertainty. Bloomberg's Zoe Schneeweiss, we thank you so much for your time joining us outside of Frankfurt. As Zoe walked us through the central banking story, of course, we've got one eye on the FX story as well. And this one is not a currency we traditionally talk about, but Valerie Teitel warned us early that it's going to be one you want to pay attention to this morning. Turns out she was right. Taiwan's dollar surging as much as 5% earlier in the session, the biggest intraday gain in over 3 decades. Now, the central bank currently holding an emergency press conference to address the move. But Valerie joins us now. Val, walk us through why we need to care about what's going on with the Taiwanese dollar.
Well, Critty, frankly, this move in the Taiwanese dollar is a monster move, a gigantic move for a currency that is quite managed by its own central bank. Today, the move was 3.6% to the upside stronger. You add this to Friday's strengthening move. In the last 2 days, this currency has moved over 7%. It marks the biggest 2-day move for this currency that we have ever seen on record. A lot of questions about what's driving this. We know that Taiwan has a large export business. Perhaps some of those exporters, like those chip makers, TSMC, are scrambling to hedge against further dollar weakness. They also have a large unhedged life insurance industry, Critty. Maybe some scrambling there as well to hedge against further dollar weakness. This was all kicked off on Friday, actually, though, with positive news between the U.S. and China trade talks. That's what really ignited this move on Friday's session as we await more comments from the central bank in just a few moments' time. We did get an update from their trade delegation, Critty. They said that FX was not part of the discussion between the U.S. and Taiwan as they've been undergoing trade negotiations around Trump's tariffs.
The Trump effect showing up on the Taiwanese dollar. Bloomberg's Valerie Teitel, we thank you so much for walking us through the importance of that story. Let's talk about the Trump effect in another part of the world here, and that is in Romania, where George Simion, an ultranationalist ideologically aligned with Donald Trump, has secured victory in the first round of the presidential election. Now, he faces a runoff against the centrist Nicosur Dan. The outcome will decide whether or not Romania challenges the European Union's liberal order. Joining us now, Veronica Anghel, assistant professor at the European University Institute and former foreign affairs advisor to the Romanian government. Veronica, a pleasure to have you on the program on this historic day. We thank you so much for your time. Just put this into perspective for our global audience about why this is so significant.
Romania is a major partner for the United States. It's a NATO member and it's a reliable member of the European Union. And the fact that we are very likely to see a president that has pro-Russian, anti-Ukraine, protectionist, anti-European, anti-EU attitudes running the country, this will have major effects on both the country's political stability as well as its ability to maintain these kind of alliances with the West.
So let's go into kind of that foreign policy implication, if we can. In terms of actual decision making, what does that look like?
The president has important powers because it represents the country in the European Council, and the president is also the one who meets foreign leaders, who leads foreign policy. However, they will enter a period of cohabitation with the government as well, and a lot of instability and uncertainty is likely to follow a potential victory for the far right. It's also a major problem for how the European Union governs itself. European Union decisions are mostly taken through consensus. And with this new far-right leadership that Romania is likely to have, and is most likely to have, this means that the EU will have a new troublemaker along the lines of Viktor Orban in its midst.
So you talked to us about Viktor Orban as well, and you mentioned earlier this kind of pro-Russian stance among this candidate. Walk us through how specifically Russia itself might benefit.
Russia has already benefited from the volatility around these elections. For your viewers, you may already know these are rescheduled elections. So in 2024, Romania had scheduled elections which were annulled following allegations of Russian interference that were since proven by different kind of reports from intelligence services, Romanian intelligence services, as well as foreign intelligence services. This led to the banning of that candidate and also to a growing distrust in institutions. This, I say, already benefits the Kremlin because it doesn't matter who wins the elections. Trust in institutions has gone down. Of course, if Romania suffers from high volatility, also in market volatility, that also benefits the Kremlin and Russia because there will be fewer resources allocated to defense. And finally, having a pro-Russian and also an anti-Ukrainian president will also lead to a decline in support for Ukraine's war efforts. Also for your viewers, I think it's important to note that Romania has a very long border with Ukraine, and it also borders the Black Sea, and a lot of Ukraine's grain trade goes through Romania. So if if a far-right protectionist president who would win on a platform of no longer supporting Ukraine, gets into power, all these problems will emerge also, and they will benefit Russia.
Veronica, talk to us a little bit about, and you kind of mentioned the foreign policies and the push and pull from various parts of the world, Russia, the EU, the United States to some extent as well. Talk to us about what this means in terms of actual functioning of the government that exists in Romania. Can they take on the reforms that are needed domestically?
It will be more difficult. The government works in a semi-presidential system, so this means that the executive, unlike the United States, is divided in its power between government and president. But most of the decision-making in terms of budget allocation, for example, rests with the government. The outcome of these elections are also likely to lead to more issues and more instability in government decision-making as well. I anticipate also market volatility over the next 2 weeks, driven by these exceptionally high levels of uncertainty. There's a potential shift in Romania's orientation towards Euroscepticism that is unlikely to be viewed favorably by foreign investors or the country's financial partners. It's important to note that according to credit rating agencies, Romania's continued classification as investment grade is primarily underpinned by its membership in the European Union, by access to EU funding. Once the leadership of the country is no longer fully committed to respecting EU rules, to collaborating with EU partners, this kind of volatility will transfer into the market. The Bucharest Stock Exchange opened today already with a 2% decline, and it's dragged down by losses in some of the most prominent Romanian stocks. Shares in banks, like local banks like Banca Transilvania, are just down by 3%. And others are also trading lower. Now that the Western markets are open, we are also likely to see a slight change in the borrowing costs as well.
I'm certainly seeing this have a ripple effect, the market responding to it in real time. Veronica, Anghel, we'll leave the conversation there, but thank you so much for that crucial context at a historical moment, not just for Romania, but all of Eastern Europe and the rest of the world. Assistant professor at the European University Institute there, walking us through those details. As Veronica was speaking, we did get headlines coming out of the Taiwanese central bank. You'll remember that we had this massive surge in the Taiwanese dollar, which ordinarily we wouldn't necessarily keep attention to, but a lot of speculation around it. You're seeing a live shot there of that central banking presser happen as we speak. Bloomberg's Valerie Teitel is here to walk us through these details. Val, walk us through what we're hearing from them right now.
Well, the big line from the Taiwan Central Bank is that they have said that the U.S. did not require a currency appreciation. There was some speculation that we know these ongoing trade talks are happening between Taiwan and the U.S. Did perhaps the U.S. push for a stronger currency as part of the bargain? That was some of the speculation. It seems like the central bank is trying to tamp down on that speculation now. They said the central bank says it won't manipulate the currency, and it has asked analysts not to comment on FX markets speculation. Now, Bloomberg did report that there was some traders mentioning that the Taiwanese central bank did step in this morning to smooth the market reaction. That is something, Crudy, that they do quite often. They're known as a central bank that wants to keep its currency at a stable level, right? They want to smooth its operations, regardless if it's strengthening or weakening. They normally step in just to help the market in terms of calming volatility. That was something that was notably absent on Friday, notably absent at the FX Open in the early hours of London earlier today. But they have, tamped down on that speculation, saying the U.S. Did not call for them to appreciate their currency.
See, Bloomberg's Valerie Teitel walking us through some of the headlines coming from that press conference from the Taiwanese central bank in light of the massive move you've seen in the Taiwanese dollar. We thank you so much. Coming up on the program, and speaking of pretty decent moves or decent size moves, oil prices also slumping this morning following OPEC's supply surge. Lots of cross currents there. We're going to dive into the details with Svelland Capital's Nadia Wiggen next. This is Bloomberg.
We look at long-term views on supply and demand to arrive at our long-term oil price forecasts, and we look at a range of prices. So projects that would take several years to develop, like a Deepwater Gulf of America project, and then would be online for multiple decades, our decision-making is really not informed by the price of the day. It's informed by our view of prices out over the life of that project, which can be multiple decades.
Chevron Chairman and CEO Mike Wirth speaking to Bloomberg on Friday after the company's earnings. This big takeaway seems to be this worry, this fear, of course, driving those oil prices lower. Chevron and Exxon, I should say, pulling back on some of those shareholder returns. In the meantime, oil prices, of course, this morning tumbling to the tune of about 2%. I feel like they've paired some of those losses earlier in the session, down somewhere between 3 and 4% after OPEC Plus agreed to another bumper output increase as a warning to the group's overproducing members. Let's bring in Bloomberg's Anthony DiPaolo, who joins us in Dubai. Anthony, just walk us through the dynamics behind this OPEC decision.
Hi, good afternoon. Yeah, exactly. That OPEC decision was to increase production going into June by more than 400,000 barrels a day. That repeats the same decision that they'd taken for May. So this month, they're adding that same amount into the market. They're going ahead with that again for a second month in June, and that's about 3 times, more than 3 times the amount that they had laid out in a plan set up to fully unwind those cuts. So they were going to take little increments of about 100,000 barrels a day, a little bit more than that, each month until they unwound those cuts. But now they're really taking these huge chunks all at once, so 3 months at a time, basically, and that's really having an impact on the oil price. We've seen that really sluggish all the way through last week, and then taking another hit today, as you would expect, as that additional supply comes into the market, and that's butting up against some concerns about uncertainty about tariffs, how the economy is going to work out, and that's what's really giving us this impact on the prices.
Well, speaking of this impact on the prices, it's surely not going to help a lot of the corporate sphere as well. We were just talking about the likes of Chevron and Exxon as well, probably not being able to make more bang for their buck. We're talking about consolidation in the corporate space on this side of the Atlantic. Shell looking to acquire BP, according to some Bloomberg sources. Can you just walk us through the benefits of both of those players if this deal were to come to fruition?
Yeah, well, BP has been under pressure for a while now because of its strategy. They had really looked at moving into renewable energy and kind of moving back from the traditional oil and gas. That strategy has not favored the European majors when compared with their U.S. rivals, who are really going still all in on the oil and gas business with some low carbon projects, of course, but a much greater focus on the oil and gas. So that's hurt BP. They have recast their strategy, as has Shell, the potential buyer in this case, if it does come to that. So they've recast to look more at oil and gas, but really BP is continuing to struggle because the investors have said, it's not enough yet. They still have not gotten it in terms of that strategy. So for Shell to look at them, they're seeing a weakened prey. They're seeing the stock price down. They could potentially use their own shares to come in, and that would add on a company that's got oil, gas production, refining, a big trading operation as well too, as these companies look to build up and get into more oil production to get back to what the shareholders want, Kriti.
Absolutely. Certainly something that we're going to be keeping a very, very close eye on. Do BP's problems get solved with a Shell takeover? Bloomberg's Anthony DePaola, we thank you so much for walking us through both the OPEC story and the corporate oil story here in Europe. Let's get a little bit more context on this area of the markets. Nadia Martin-Wiggen, director of Svelland Capital, joins the program this morning. Nadia, when you see giant price drops, I should say, like this, my immediate thought as a girl from Texas is what happens to U.S. shale production. Is that where the U.S. is poised to lose some market share when it comes to the global export market?
Absolutely. U.S. shale is what reacts most quickly, but already we see that the sector is under pressure because if we look where we were on total U.S. crude and condensate supply, in December we are at 13.5 million barrels per day. That fell to 13.15. In January. Yes, we had winter storms and cold weather and so forth, but we only gained back 50,000 barrels per day of that in February. When you look at the Fed survey, the uncertainty for the E&P industry in the U.S. is enormous right now on the oil side. So when I look at our forecast at Svelland Capital for December production in the U.S., it's looking flat year on year. If you'd asked me last October, I was talking about 400,000 barrels per day year-on-year growth minimum. So the impact is definitely there. And that's already at these prices. And when we look at next year, that's where the bigger impact comes because we could lose another 400,000 barrels per day and see an actual decline year-on-year.
It's fascinating because, Nadia, the Federal Reserve of Dallas put out some data over the weekend that talked about where the break-even rates for a lot of those shale players actually are. I'm looking at a Permian Basin number as low as 61 on one part of that kind of area in the Midlands. Talk to us a little bit about the staying power of OPEC Plus here relative to that of U.S. shale. At these lower prices, how long can OPEC Plus keep pumping the market?
So the cost of production for OPEC is super low. And as we learned during the COVID volume war, Saudi Arabia will be the last man standing. They can keep pumping as much as they like. However, what they did in that situation, if they were to go for a full volume war, we'd expect it to last a month, 6 weeks, just enough to bring down the oil price massively and have curtailments happen across the globe. What we've seen that they've done now, adding 400,000 barrels per day for June, after adding 400,000 barrels per day for May, when I look at my balances for June, July, and August, I still see draws because we're going into the peak demand season for crude consumption because we need to refine products for summer driving. We need to refine products for cooling when it's very hot weather in Europe, very hot weather in the Middle East and in Asia. But the Middle East is the biggest driver there. So they could actually continue doing this again in July and even in August. So we get 1.2 million barrels per day additional crude. The problem is in October, and this is when you look at the shape of the oil curve right now. October is the first month that going into November, you see that contango, and that's because my balances show a build of more than 3 million barrels per day, and that is the problem with the strategy. Right now, they can just keep adding, but then are they willing to cut if we get a big oversupply, and especially if we get a demand impact from these tariff ongoing discussions?
Nadia, I'm putting you on the spot here. 20 seconds if you can. Give us a floor, give us a ceiling for Brent.
Right now, we see that the market has actually responded positively. We dropped down to 58.4 on the 9th of April. The market is max short, or it would be trading down right now. So we actually see upside from here. I think above $70 a barrel Brent, then we're going to start to see headwinds. Also, when we're in the lower 60s, we can get a demand response in the US and in OECD Asia. That is positive.
The call from Nadia Martin-Wiggen, director at Svelland Capital. We thank you so much for that crucial insight as we see these oil markets continuing to drop. I'm looking at Brent crude at $60 a barrel, NYMEX at 57, and the markets that are kind of virtually unchanged when it comes to the equity story. Some underperformance in the CAC 40, plenty of ex-dividend stocks there, down about 0.6%. Also seeing the pictures of U.S. futures continuing to worsen, down a whopping 0.9% right now as well. We are live from Milken all of this week. We're speaking to the biggest names in business. Be sure to stay tuned for that coverage. This is Bloomberg.